Most people use money every day. They earn it, they spend it, they save it. But very few people stop and ask a simple question: who actually controls it? This is Capital Clarity, a channel where we explain how money works clearly, simply, honestly. Money feels like something stable and fixed. You see numbers in your account, prices in stores, salaries at work, and it all seems part of a predictable system. But behind that system there is a structure that most people never see. Money is not just created randomly, and it is not only controlled by governments or banks in a simple way. There is a mechanism, and at the center of that mechanism are institutions called central banks. Central banks do not control your personal money. They control the system in which money exists. Their role is not to decide what you buy or how you spend. Their role is to influence how money moves across the entire economy. And they do this through a few key tools. A central bank is an institution that manages a country, its currency, money supply, and financial stability. Examples include the Federal Reserve in the United States, the European Central Bank, and the National Bank of Ukraine. These institutions operate at a level above regular banks. They do not deal with everyday customers. Instead, they interact with the financial system itself. An economy cannot function well without some level of control over money. If too much money is created too quickly, prices rise. If too little money is available, economic activity slows down. Central banks exist to manage this balance. Not perfectly, but consistently. One of the main ways central banks influence the system is through money supply. This refers to how much money exists in the economy. They can increase it. They can slow its growth. And these changes affect everything from prices to employment. When more money is available, spending tends to increase. When money becomes tighter, spending slows down. The most important tool central banks use is interest rates. Interest rates affect the cost of borrowing money. When rates are low, borrowing becomes cheaper. People and businesses are more likely to take loans, invest, and spend. When rates are high, borrowing becomes more expensive. Spending and investment slow down. This single mechanism influences a wide range of decisions across the economy. From buying a house, to starting a business, to saving money. Central banks do not control the economy directly. They influence it. They adjust conditions, and then individuals, businesses, and markets respond. This means their power is indirect. They set the environment. Others act within it. Even though central banks operate in the background, their decisions affect everyday life. Interest rates impact loans, mortgages, and savings. Changes in money supply influence inflation, and inflation affects how far your money goes. So while you may not see these institutions directly, you experience their impact regularly. It is easy to think that central banks fully control money in a simple, centralized way. But the reality is more complex. Money is created not only by central banks, but also through the banking system itself, especially when loans are issued. This means control is distributed. Central banks guide the system, but they are not the only participants. When you combine central banks, commercial banks, governments, and markets, you get a system where control is shared. Each part has a role. Each part influences the others. And the result is a dynamic system that constantly adjusts. You do not need to understand every detail, but understanding the basics changes how you see money. You begin to realize that interest rates are not random. Inflation is not accidental. And financial conditions are shaped by decisions made at a higher level. This does not mean you have no control. It means you are operating within a system. Instead of seeing money as static, you start seeing it as something influenced by policies, conditions, and decisions. This shift helps you make better choices, because you are no longer reacting blindly. You are adapting to how the system works. No single person controls money. No single institution fully controls it either, but there are structures in place that guide how it moves, and central banks are one of the most important parts of that structure. You do not need to control the system. You need to understand the environment you are in.